to EarningsBeats, or those of you who just started with EarningsBeats, to check that out. And the reason I'm saying that is because it really covers a lot of the important aspects of our service. So if you get a chance, go ahead and check that out. The other thing I'd like you to check out is our calendar, also at EarningsBeats.com, because the calendar lists all the events we have coming up. And the one I really want to draw your attention to is the event next week, the 21st of October. So tonight is a preview of what we're going to cover during that event, but this is sort of a light version. So figure next week, we're going to be looking at much more in-depth, because a lot of companies will have reported by then. A lot of companies will be getting ready to report their earnings. And what Tom is going to do when everybody joins us next week is he's going to get deep into earnings. So tonight's really just kind of a little preview of what to expect. That is a member-only event. So you have to either be a trial member or a full service member. And if you go to the website again, EarningsBeats.com, you'll see there's a way to sign up as a trial member for just $7. But you'll also notice at the top of our site, there's a webinar special. The webinar special, I'll talk about it a little bit later when Tom takes a pause. This is the way to go if you're going to be with us for a while and you want to save a lot of money. It's an annual membership. It'll cut your cost in half and get you access to everything that we have to offer. And so I encourage everybody who's thinking about joining to really consider checking out the webinar special.
Hey, John.
Yep.
I'm sorry, I didn't know if you were trying to share, but I'm not seeing anything up on the screen.
I've been trying to share, and for some reason it's not allowing me right now.
Okay.
Yeah, so this is why I'm just relaying some things. Hopefully I'll be able to get it fixed so I can share a couple things later. But right now it's not allowing me to share. So anyways, that's why I'm asking people to go right to the website at some point, EarningsBeats.com. Check out that webinar special, because it really is the way to go if you're going to be with us. And last thing I want to say is there is a, here we go. I think am I sharing now, Tom?
No, I'm sharing.
Oh, you're sharing. Okay. There it is. There's your EarningsBeats special. You got to sign up by midnight tonight. Trust me, it's the way to go, because we've got a lot of exciting things coming up, including, by the way, hey, Tom, can you click on the event calendar for me? There it is. Yeah. Yeah. All right. So I mentioned the event calendar. So if you see on the 21st, if you just go down to the 21st and click on that one. Yep. It'll give you a description of the actual event, and you can do, every event is either listed as a public event or a member event. So that one's going to be a member event. And then won't look at it now, but in November, that's going to be November 19th is going to be our top 10 stock pick webinar. Extremely popular, where Tom discusses 10 different stocks in different categories, something that you want to really take advantage of. And the last thing, it's not on here now because this just developed, but I want to also mention to you, you'll see it there by tomorrow, probably by tonight. This Friday, this upcoming Friday, I think that's the 18th, Tom Bowley is going to have a special Friday presentation, earnings season kickoff, and Mary Ellen McGonigal, the president of MEM Investment Research, is going to join him. She was a regular Friday guest on the Market Watchers Live Stock Charts TV's flagship show that Tom hosted. And both of them provide excellent technical analysis during their shows. And this is going to be a great one because it's going to be an hour long and going to feature stocks that interest both Mary and Tom based on the performance and technical setup. So we'll make sure everybody gets notification. It's not on the calendar events right now, but that'll be next Friday. We'll make sure you get a heads up. And of course, make sure you join Tom every morning for his market update when he does his Trading Places Live. Okay, on that note, I think I'm just going to go ahead and turn this over to Tom. I think Tom needs no introduction. You've been following him on for a long time, many of you at stockcharts.com. Now he's our chief market strategist at EarningsBeats.com, and I'm going to send it his way. Take it away, Tom.
All right, sounds good. Thanks, John. And sorry for the delay there to get started. I do want to just point out, and for some reason the headings up here are not coming through on my screen, but there is if you go to EarningsBeats.com, you will see a heading up here. It says webinar special. You click on that, and that's where you will get the information that John was talking about earlier. So just go to EarningsBeats.com, and you can check that out if you're new to EarningsBeats. All right, what I want to do today is it truly is a preview for earnings season. So next Monday, when we get into our webinar, we'll actually have a couple hundred reports already under our belt. So right now, we are literally sitting on the cusp of earnings season. The next 3 to 4 days, we're going to get a number of reports out. Like I said, probably a couple hundred. Many of the largest companies report first. So we're looking at some really big, visible, influential companies that are going to be reporting this week. I'm going to go over some of those later in this webinar and just give you my thoughts on how I think they're going to report based on the way they've been trading. How they react to those reports is very difficult to predict. However, even stocks that look super on their charts and look like, hey, we're going to get an earnings beat, a revenue beat, a lot of times we get those beats, but then the stock pulls back. It's a buy on rumor, sell on news kind of event. So the stock goes up in anticipation of strong results. Then you get the strong results and the market sells off. So trying to predict how the market's going to react is very difficult. But I do think that the relative strength and the way the stock is trading and the volume trends and so forth can give us a pretty good feel as to the type of report we're going to get. And so I want to talk about that. I'm going to get into that in a bit. For those of you who are new to Earnings Beats, I do want to go over a couple of things first. If you've been with us for a while and you follow me on my shows and so forth, I think you're going to find this to be more of a refresher. Maybe you might pick up a couple extra little nuggets of information. But those who are new to Earnings Beats, I think really is going to hopefully get something out of taking a look at the overall market. So before I get into some predictions for, looking at the market and making predictions on different stocks and so forth, let's just take a look at the overall market, because I really believe everyone that looks at the market has to change their mindset from where we were even a few years ago to where we are now. I think that without a doubt, in my opinion, we have moved into a secular bull market. And let me explain the difference. If you go back, and this chart is of the S&P 500, it's a monthly chart that goes back 100 years. That's a representative sample, I'd say. When you look at it, we go through periods. It's almost generational type periods where the S&P 500 just does a lot of choppy action back and forth. We have both bear markets and bull markets all combined in one extended period where the market goes nowhere. We did it from 1930 back, well into the 1940s. We did it again in the late 1960s to the early 1980s. And we just did it again from year 2000 through year 2012. And if you look at these patterns, they look a lot alike, where you have a pullback, then you have another big move to the upside. So you have what's called a cyclical bull market in a secular bear market. And then you have the next bear market. And then you have another bull market, and then you have consolidation, and finally you get a breakout, and that 12-year torturous period of going nowhere ends, and things begin to change. The market tends to ignore most bad news and goes higher for a long period of time. 1950 to 1969, that was 19 years here in a secular bull market where the S&P averaged going up 11.28%. through that almost 2-decade period. Then we went through that secular bear market. Look at the average return during those 12 or 13 years, only 2.8%. Then you go through another secular bull market where the average return over almost 2 decades was 15.4%. Then we go through the last, through this period, this 12, 13-year period, average return was just 1.55% per year. And now I believe we have started a long-term secular bull market. Since 2013, we've been averaging 10.5% per year. I think that's going to continue. Now, and the reason I bring this up is everyone got, petrified back in the fourth quarter of last year when the market took the tumble. And now in the rearview mirror, it just kind of seems like a blip on the radar. That's what happens during secular bull markets. I wanted to go back into the 1980s and 90s and just give you a little run through history, because if you've been investing in the stock market for no more than 20 years, you don't remember what happened back in the 80s and 90s because you weren't investing. A lot of people are already biased towards being in a bear market, a secular bear market, where every time the R word, recession, is mentioned, the market, you think it's going to be a 40% bear market. And that doesn't happen during secular bull markets. So let's just take a couple minutes here. 1987, you see this little move down here? It wasn't a little move back in 1987, I can tell you that. It didn't feel like a little move. After moving down a couple years later, though, we had recovered all of it, just kept going higher. 1990 and 1991, there was a recession. You don't really see it here, but that was about a 20% move down in 3 months. Does that sound familiar? Because that was about what we had the fourth quarter of 2018, 20% in 3 months. In 1998, see this little pullback here? That was a recession. Well, it wasn't a recession. Actually, I don't think we had 2 consecutive negative quarters, but it was a 20% pullback in the market in 3 months. So for those of you who maybe haven't traded that long a time, or maybe those of you who have and just don't recall, let's go back down memory lane. Here was 1987. So here's 1986 going up. What a lot of people don't tell you about the crash in 1987 is that the stock market, the S&P 500, went up 50% in 11 months before the crash. And when it crashed, all we basically did was give back that 50% move up. So we were kind of back where we were before we had the move. The market just got too far ahead of itself. I mean, it's easy with hindsight to go back and say that now. Trust me, it wasn't that easy back then. But in putting things in perspective now and looking at long-term secular bull markets versus bear markets, we're going to have big moves to the downside from time to time. Not generally are we going to see a crash like we had in 87, but we're going to see pullbacks. And let's fast forward here to 1990. So here was 1990. See where we were in July of 1990? See where we were 2.5 months later? That was a 20% drop. And then 3 months later, 4 months later, we were right back to those highs, and it was like it never even happened. 1998, here we were in 1998, sailing along. In July, we topped. Early October, we were down 20%, maybe even by early September. It was pretty close to 20%. That should look somewhat familiar because at the end of 2018, that's what we did here. This moved down from just under 2950 to 2350. That was a 20% drop. It's a lot more points because the S&P 500 is a lot higher, but it was a 20% drop in 3 months, just like we saw back then. And now look at what happened in 2019. It's like that's just a distant memory. I think everybody needs to get used to this because I believe in a secular bull market, that's the type of move to the downside that we are going to have from time to time that we just need to learn to, I'm not going to say ignore. I mean, if we see as a short-term trader, if you see something brewing, you want to move to cash, let your stops take you out, but don't think that we're back in 2007, 2008, or in 2001, 2002. This is a different market, in my opinion. Maybe I'll be proven wrong, but until I'm proven wrong, I'm going to stick with this. I believe we go a lot higher over the next 10 years. As you go through these different generations, you have a couple of opportunities in your lifetime to hit the stock market when it is in full gear. I think we are now in one of those periods after struggling for 12 or 13 years in a market that really changes your psyche. You know, you really think that the market can't go higher, and when it does go higher, you don't want to believe it. There's just too many things that are just wrong with the system. You know, the financials aren't participating as much as they should. We've got a Fed, you know, that has been, you know, QE this, QE that. They're starting to put more money into treasury bills, 60 billion worth a month for the next several months at a minimum. And everyone wants to take that information and say, well, you know, this can't be. Well, I think that QE is actually what triggered this bull market. You don't want to fight the Fed. When the Fed is doing everything it can to strengthen the economy and to inflate prices, stock prices, the last thing you want to do is bet against them. So I think that this is going to be known as the Fed QE period of stock market boom. I don't care who gets elected next year. I don't care about the short-term direction of the 10-year Treasury yield. I'd love for it to go up because that means money's rotating out of Treasuries. We'll talk about that in a minute. But my point here is we are in a different generation of the stock market now than we were 10 years ago. And if you continue to treat the stock market like we did 10 years ago and panic every time the market goes down, I think you're going to miss out on something big. My view, my personal opinion. Next up, employment versus the S&P. I wanted to also point out, and I've shown this chart before, these blue X's down here mark when we had recessions. We don't just have recessions in secular bear markets. We also have recessions in secular bull markets. That 1990 move to the downside that I showed you right here, this was about the time we went into a recession. I mean, right now, I think because of recent history, we think recession, we think market crash. That is not the case. That's not the long-term case in U.S. stocks. Again, in a secular bear market, yeah, when you have a recession, nobody wants to be in stocks. So the money that pours into treasuries comes out of the stock market. No new money comes in. Everybody's scared to death. And so it takes a long time to get through that process. These two drops here got us through that process. These two drops here got us through this process. These two drops here got us through this process. Then we go into these periods where recessions are bad and they slow things down, but they don't trigger a secular bear market. They trigger a cyclical bear market. Much, much different. Now, one thing that you'll notice is that every one of these recessions, every single one except the one in 1968, or I think it was late 1968, early 69, every other one of these blue X's, you will see that the rate of change of jobs went negative. Now, everybody's screaming right now that we're heading for a recession. Stock market keeps going higher. The jobs are still positive. I mean, they could turn and go lower. But if they do, I believe it's just going to be part of a cyclical bear. If, in fact, we even go down 20%, I don't think we will. But I just want to point out that you've got to recognize the difference between the markets that we're in. Next up, this is the XLY XLP. This is another chart I think is really important that we follow. Why? Well, consumer discretionary versus consumer staples tells us whether or not traders have an appetite for risk. If you look at the recent GDPs, analysts taking a look at those pointed out that the main reason that we had GDP growth was because of a strong consumer. Well, knowing how consumer stocks are behaving, discretionary versus staples, helps us to understand what kind of mentality the market has, what kind of mentality traders have. And if you notice from early 2016 through the middle part of 2018, we had a rally in this ratio, XLY versus XLP, unlike any other that we had seen. 2012 and 2013 was similar, and then we consolidated sideways while the market consolidated. And now we're kind of doing the same thing. See how we're consolidating while the stock market's consolidating? I would be okay as long as this ratio doesn't go down below about 1.80. We're at 1.99 right now. I would also not be surprised if we took off back to the upside in a market that breaks out. But I just want to point out this isn't something that I feel has to happen. I don't feel like if we break out the new highs, this ratio needs to go soaring up to 225, because I think that there was already so much movement to the upside. It's okay to consolidate that move, just like when a stock moves up. You know, a stock goes from $4 to $20. It just went up 500%. If it drifts back down to 15 and stays there for a little while, it's not that big a deal, even if the market keeps going up, because you had such a huge run. It needs to consolidate, it needs to base. I think this ratio, it would be okay if it bases. I just want consumer stocks as a whole to perform well. All right. If I go down here, you can see the S&P 500, you can see the XLY, XLP, and then down here at the bottom is a correlation. And what this tells us is that the direction of the S&P 500 is very positively correlated to the direction of this consumer ratio, the XLY to the XLP. That's why all these readings over the last 10 years, almost all of them, are in positive territory. We had a few where we would just barely move in the negative territory or briefly, and then we'd come right back up. Most of these were during consolidation periods, but overall, I think you can see that the tendency is that if the XLY, XLP is going higher, then it drives the S&P 500 higher. So this is one chart that we absolutely want to continue to monitor. Another chart that we want to monitor is transports. And I've talked about this so much in blogs and in the shows I've been doing and webinars that we've been having. And it bears repeating, because when you look at the performance of the S&P 500, when it goes higher, these blue directional lines, when we are really making a move to the upside, look at what transports are doing. Transports are doing the same thing. Small caps also doing the same thing. When the S&P goes through these periods of consolidation, the red circles here, look at what the transports are doing. Transports are generally downtrending. So if the and that makes sense, transports should be leading our economy. We should be seeing transports performing well in anticipation of stronger earnings reports. As the economy begins to expand or the market begins to feel like it's going to expand, transport should begin to lead. It's part of the Dow theory. If you've ever studied the Dow theory, the Dow Jones Industrial Average is moving higher. You really want the transports going up, or the Dow Jones, the big 30 conglomerates, if they're going up, it's nice to get that confirmation from the transports. All right. And again, you can see here the correlation, very, very positive between the S&P 500 and the transport. So in other words, if you think that the S&P 500 is just going to explode and the transport's just going to continue to languish, that is probably not going to happen. If the S&P 500 is really, truly going to take off, we need to see transports doing well. And then this is the last one I have here. This is the 10-year Treasury yield versus the S&P 500, going back the last 10 years. And essentially what I've tried to highlight here in the shaded areas are when the 10-year Treasury yield is moving higher. Also, looking at this, the 10-year Treasury yield when it's moving lower. When it's moving lower, generally the stock market is struggling because money is rotating into Treasuries. That's why the yield's going down. So every dollar that goes into Treasuries can't go into equities. So that should be one of the clues that the equity markets probably are going to struggle. Now, if we see this kind of action in a bear market, in a secular bear market, the S&P 500 usually gets crushed. The reason that we're seeing 10-year Treasury yield go down and the market it's struggling, but it's still going higher. Here, when the 10-year Treasury yield went down, same thing. 10-year Treasury yield went down, we consolidate. 10-year Treasury yield goes down, we go up a little bit. Goes down, we consolidate. Goes down, we consolidate. Goes down, mostly consolidate. The reason that we do that is because in a secular bull market, money comes in, new money comes in to the market. So while the rotation might be somewhat skewed from stocks to bonds, there's enough new money coming into stocks that it holds them up. In a bear market, money comes out of the market. And so that that movement, that transfer of money from the stock market to the bond market gets overblown. I mean, that's when we have the big moves to the downside. So I believe we're in a market where we're going to continue to see money coming into the stock market. And any pullbacks, in my opinion, again, just my opinion, feel free to disagree. That's what's great about the stock market. You can have your own opinions, and that's what, you have two sides of the trade. But I believe the stock market's going to go a lot higher. And when this race, or when the 10-year Treasury yield is rising quickly, like here and here, this was one of the best advances during the current bull market. This is when I believe we broke into a secular bull market. It occurred when money was rotating away from treasuries. So that helped to fuel. Not only were we getting new money in to equities, but we were getting money rotating from treasuries. So it was really just a double positive for stocks. And that's what happens when we get these big moves to the upside in the treasury yield. It helps to fuel big advances in the S&P 500. And once again, you can see down here at the bottom, I didn't shade it, but most of the readings over the last 10 years are positive, meaning that the direction of the yield and the direction of the S&P 500 are positively correlated. So if there are three things you want to take away when you're looking at the stock market and trying to evaluate, number one, consumer stocks. If consumer discretionary is outpacing consumer staples, that would be a really good sign for the market. If we've got transportation stocks breaking out and starting to trend higher, that is a very big positive for the stock market. And then finally, if the 10-year Treasury yield is moving higher, and I'm not saying we need to have a 10-year Treasury yield that goes from 1.5% to 6%. I'm just talking about when we get moves to the upside, when we start to see big moves up in the 10-year Treasury yield, and we're down close to multi-year lows right now. If we get a big jump, and let's say the yield moves from where we are now, maybe up to 240, 260, maybe even back to where we were a year ago, 320, 325, that would likely coincide in a massive advance in the S&P 500. So these are three things you want to watch: consumer stocks, transports, 10-year Treasury yield. They will give you some really significant signals about the direction of the stock market. Pay no attention to CNBC. They are fear mongers. That's what sells. That's what gets them their ads, their ratings. That's how they can go out to their advertisers. They want to sell you on the train wreck that might happen, not the Boy Scouts out doing good deeds. I think the next 10 years is going to be the Boy Scouts. All right, I'm going to go into some individual stocks. And the difference between this week and next week's, this is the preview. I'm going to give you some stocks and what I think they're going to do. Next week, we can take a look back and say, okay, I was wrong on this one. I was right on this one. Maybe we'll learn some things as we go through here. That's why I like to make these predictions. That's why I like to study these charts. And then I like to see the results because I want to learn, continue to learn. If you think you've learned everything in the market, that's probably when you ought to go taking up golf or hiking or something else, because you'll never learn everything in the stock market. The stock market's a constant teacher, and it just depends on how much tuition you end up having to pay. As you learn more and more, hopefully the tuition costs go down. That's the whole idea. All right, I'm going to go in. John, I don't know if you want to talk at all about the special now before I get into the stocks, because I'll probably go for another 30 minutes or so on the individual stocks, but what do you think? I'm not sure if John's around. John, are you there?
I am.
Okay.
Yeah, no, I'm going to go ahead and let you just continue. What I'm going to be doing is I'm going to be sending out an email to everybody as soon as recording's available. And in that recording, in that email, there'll be a link to the webinar special. And they can also go to the website. There you go. If you go right to the website, you see in the top of the page, you'll see webinar special. This is really the way to go if you want to save a ton of money over the next year. And honestly, what we've really found is that people who stick with us. Like over the course of the year, that's 4 quarters. That gets you access to everything that you see on here. We're not going to get into it tonight, but our strong earnings chart list, for example, we have over 300 stocks on that list. And now that we're getting into earnings season, that's going to be updated. There's going to be a bunch of new stocks that Tom has identified as potential high reward to risk trading candidates. It's awesome. That list is really awesome. Also, as an annual member, the one thing you get that you can't get unless you're an annual member is our relative strength chart list, where there's 104 industries that are covered, and you get access to that entire list. And when you marry the strong earnings chart list with the relative strength chart list, it becomes a very powerful tool. So anyways, I'll make sure I include a link to that. You don't have to wait for that. You can go ahead and sign them now if you want. I'll make sure I include a link along with the recording. Hopefully I'll be able to get it out tonight. At the very latest, it'll be right in the morning, but hopefully tonight, and give you an opportunity to really save a lot of dough. All right, back to you.
All right, sounds good. Thanks, John. All right, so I'm going to go through earnings reports that are coming out over the next 4 days and just give you some thoughts. I mean, there's probably, like I said earlier, a couple hundred reports that'll be out. Maybe not quite that many, maybe 150, I don't know. But what I did is I probably have about 15 or 20 of them that I'm going to make a call on, that I either like it or I don't like it heading into earnings. And then we can have a little fun maybe next week and come back and take a look at these and see which ones panned out, which ones didn't. So I'm going to start with Tuesday's earnings reports coming out tomorrow morning. First one, JP Morgan. And over here on the left-hand side, you'll see either the green arrow straight up, the red arrow straight down, or a black arrow that goes sideways. And the green arrow, of course, means I like the report. I like what's going on here. I think that the company is going to have a strong report. And the reason, if you look, obviously we are in an uptrend on JP Morgan. Banks have been going sideways. So what does that mean? JP Morgan relative to the banks right now is right at a 52-week high. So Wall Street really likes JP Morgan. And if Wall Street likes JP Morgan, I like JP Morgan. I think we're going to see a nice report here. Next up, Citigroup. Another one you can see, I got the green up arrow here. I think Citigroup looks pretty good. Hasn't hit a 52-week high, but I think the overall trend on a relative basis has been pretty good. Again, you've got the banks, which have been going sideways throughout the year. Citigroup's got a little bit of an uptick, little slanted move to the upside. You can see this high here took out this prior high, whereas the banks just kind of went up and tested it. The lows here are even, but when you go back and look at the bank lows, it actually went a little bit lower. So we're just seeing a little relative strength on Citigroup. I think that's going to be enough to propel Citigroup to a good report come tomorrow morning. Next up, Netflix. Not a fan. There's my red down arrow. I think, number one, the stock's been trading down over the past few months. So look at the volume trends. Now, the volume has picked up a little bit back on the way back up to the upside. I'm not so sure this isn't just short-term traders, though. We've gotten back up to gap resistance and the 50-day moving average. It needs to do something else to convince me. When you look at the relative strength, look at Netflix relative to the internet stocks. It was going down for several months, and that really accelerated here over the last 3 months. And when you combine poor relative strength and heavy volume selling, I don't know what's going to come out with Netflix, but I would not want to be holding it into its earnings report. Maybe they come through. You know, some companies are they're mum about what's going on with their earnings. They don't tell Wall Street. So, you know, the way Wall Street's trading, it's possible maybe things are improving at Netflix and they just haven't shared it with analysts. But by and large, when I see a company that's underperforming like this, selling off on big volume, it tells me there's distribution. Distribution means Wall Street is not liking the company. They're the ones that send their analysts out, talk to management. So if they're going out meeting with management and coming back to their offices and selling, then I don't want to be a part of it. I want to see something that convinces me first that Netflix is ready to go higher and move, break above the 50-day, good solid earnings report, maybe raising guidance, and a move technically that clears some overhead resistance, then I would be, willing to consider Netflix for now. I'm thinking they could have some bad news here. I'm going to pass on Netflix. Prologis, PLD. This is actually a REIT. And look at the chart continuing to move higher. Look at the relative strength across the board here. Everything kind of pointing higher. So I'm not really into REITs. I would much rather get into some of the more aggressive areas of the market. But some of you who do like, real estate and maybe some more income-oriented stocks, I haven't looked to see what kind of yield we have on PLD, but I can go back in here. And let's see. How about if we put on the full quote? See what this does. Well, it's got a yield of 2.4%, so it pays pretty good dividend. But the stock's been going higher. I think that PLD will have a good report. So there you have the green arrow. JB Hunt. This one's going to be a big one for me. I talked about transports earlier. Truckers, I think, are starting to show some pretty good life. I'm going to go over to this other chart and just pull up the truckers. And I think what you're going to see was the breakout here in September above these prior highs. We pulled back, went a little bit below the moving averages, but we're starting to strengthen again. And when you look at the truckers relative to the S&P 500, we bottomed back in July, and we've been seeing some real nice relative strength. Even the selling that we saw in the JB Hunt and in the trucking group in general did not take out the prior lows, and on a relative basis didn't take out the prior lows. And now we're starting to turn back up again. JB Hunt could be one of those that really surprises us to the upside. It did it back in July, huge volume, I think has started an uptrend. Notice when we pulled back, all we did was we came back and tested this area of price support and gap support. So I think JB Hunt's going to be one to watch. I like it. I think they're going to have good numbers. And then a smaller one, I think they're maybe a little over $1 billion or $2 billion market cap, so they're much smaller than some of the others I just talked about. But Sleep Number, back in July, huge move up with earnings, came all the way back down, but I think it's starting to build back up again here with increasing volume. And you can see the relative strength that just moved up to about a 7-8 week high as we get closer to their earnings report. This one is really more of a crapshoot, very volatile, could be anywhere. It's got multiple gaps all over this chart. So if you get in, if you're holding into earnings, you really have to understand that you are rolling the dice. But I believe it's going to come out with good numbers. Those are Tuesdays. Let's go to Wednesday. Bank of America. Notice here, just sideways black arrow. When I look at the relative strength, Bank of America versus the bank index, it looks to me like Bank of America is just going along for the ride with what the banks overall are doing. I'm not seeing Wall Street on a relative basis pouring in here. And if they're not doing it, why should I? I think JP Morgan looks much better. Citigroup looks much better. And I'll have another one or two, I think, coming up here in a minute that look much better. Next up, ASML. This is in the semi space. I really like what's going on here. Great volume trends, beautiful uptrend. Look at the relative strength to the semiconductor group. And look at semiconductors, been in about a 4 or 5 month uptrend versus the S&P 500. So you got a good group, and you got one of the strongest stocks within the group. I think Wall Street's expecting a big number. I think we're going to get one. Is it already built in? 6 weeks ago, this stock was trading, or maybe 2 months ago, it was trading 50 points lower. So it may come out with a great report and pull back because it could be buy on rumor, sell on the news. But I do think you're going to see some strong numbers here. PNC, here's another one of those banks I like. Got the green arrow there. I think if you look at the relative strength, PNC on a relative basis just broke out earlier this month versus the banks. So I think overall this one looks good. This is going to be kind of key for the market too, I feel. If the 10-year Treasury yield can continue moving higher, the banks, and don't overlook what the Fed just did by saying they're going to buy $60 billion worth of Treasury bills. What they're doing, and they flat out have said it, is they're looking to steepen the yield curve. Well, steepening the yield curve is nirvana for banks. That's exactly what they want. I audited banks when I was in public accounting years and years ago, and I can tell you that when that yield spread starts to widen, the bottom line for banks goes straight up. So they could be, getting fuel from the 10-year Treasury yield moving up, also from the Fed and what the Fed's trying to do. And so if I was going to get into banks, I'd want to be in some of them that are showing relative strength. PNC fits the bill along with Citigroup and JP Morgan. PGR, I'm going to go with a no. Stay away here. Progressive has been downtrending, struggling to get back through that 50-day moving average. I almost went with the black sideways arrow because of all this volume coming in. But all we did is really go back and fill this gap, get to the 50, and then that bearish engulfing candle starting to roll back over again. And look at the relative strength. We topped 4 or 5 months ago. So, well, a little over 4 months ago. So I'm just seeing a stock that's not too far from its 52-week relative low as we head into earnings season. So I'm going to stick with that red arrow. I would be a little cautious heading into PGR's earnings report. All right, just a few more for Wednesday. Comerica. Here's a bank. Notice anything different here? It has been downtrending. It gapped down on big volume end of July, came back up, filled the gap, and looks to me like it's rolling back over again. Look at the relative strength. So do you want to own a stock that Wall Street likes and money is rotating in, like PNC and Citigroup, JP Morgan, or do you want to own a stock like CMA, which has been downtrending relative to the banks? I want to stick with the winners and the leaders. CMA, I'm going with the red arrow. SLG, this is in real estate. SL Green Realty Corp. Been downtrending. I'm going to go with a red arrow again on this one. Look at the relative weakness. Months and months and months of poor performance. It's been in a pretty good group, but it has just not performed well. So even though the group has held up okay versus the S&P, SLG has been a horrible performer relative to the S&P. Also, when I look at this, I saw some volume coming into the upside here, but on the last push to the upside where we failed at the double top, there was not nearly as much volume. And then we had this big red candle. I don't know. Downtrend looks to me like it's still in play. I would be careful heading into this report. The last one for Wednesday is Heartland. Here's another trucker and another one that looks good to me. Big breakout here in early September, clearing these prior highs, pulling back to the 20-day, trying to turn back to the upside here. Look at the relative strength's been building versus the truckers. And as I mentioned earlier, truckers are looking good. So all of these charts really starting to point up from left to right. That tells me that this is a stock that's in favor. I think there's a reason for it. I think we're going to find out on Wednesday. Thursday earnings reports. Danaher, DHR. Danaher tried to break out here in September, pulled back. Notice this support level. This is where we had broken out from back in June above that prior high. Each one of these pullbacks just below 135 has been holding. I think we're just sideways consolidating. I looked at it and I saw, we were going down a little bit on a relative basis, but I still like the medical equipment group as long as we hold this relative low. So I am going to lean based on some volume trends that look pretty good. That last push to the upside came on good volume. The recent selling has been on less volume. This one, maybe is leaning a little bit toward the upside. So I'm going to go with the green arrow on Danaher, and I think we'll get a better than expected report. BB&T, this is another one of the strong bank stocks. Earlier this month, really just a few days ago, BB&T at a relative 52-week high versus the bank index. So BB&T, another one of the bank names that I would choose if I was looking for a bank. SunTrust, another one, broke out here in September, pulls back a little bit below the 20, now starting to rally again. And once again, you can see another one of the banks breaking to a 52-week relative high. MTB, now this is another bank. This one down. You can see the red arrow. Not really a fan here. Big selling back in July and August. Came back up. Volume was not bad, but we haven't been able to extend it. And when we look at that relative chart, instead of hitting a recent 52-week relative high, MTB just hit a recent 52-week relative low. Not interested in that. I don't want to see a stock that's underperforming all the other stocks, peer stocks. So I am going to pass on MTB. I don't know what kind of report they come out with, but I wouldn't be willing to stick around for it. Team, and I tell you what, I went back and forth on this one. And the reason I wanted to mention this one, this is going to be one of the software stocks, one of the early companies to report in the software space. And software, It's been a trying group over the last couple months. We're starting to see some of them regain their strength. Shopify had a great day today, starting to strengthen. Coupa Software, I mentioned a few weeks ago, that one's come all the way back and moved to a 52-week high. But there's still a number of them, like Team, that seems to be mired in this downtrend and just can't quite get things going yet. The volume trends here are a little weak, but overall, I mean, it's not that bad relative. You know, you got a relative high, relative low, higher relative high, higher relative low so far. I don't know. I think this one could go either way, and that's why I've got this black sideways arrow. I do think, though, if you're in software stocks, you would really like to see Team come in with a better than expected report, just so that it begins to paint a little bit more favorable picture on this group. I own AYX. I own APPS. Those are two software names that I would really like to see Team report strong. Hopefully get those two stocks that I own moving up in sympathy. All right, last one for Thursday is E-Trade. I do not expect anything good coming out of this report. You look at the last couple of weeks, wow, big rally. Well, it came after E-Trade announced, along with the other online brokers, that they're going to be offering free commissions. E-Trade and Ameritrade are a little different than Schwab. Schwab can make money off of their assets more so than Ameritrade and E-Trade. E-Trade and Ameritrade depend much more on on commissions and the revenue from commissions. So I think this move up, that was a shooting star candle that failed at the 20-day moving average. I think E-Trade's rolling back over, and I would not be surprised with their earnings if they're back down to 35. So I'm giving this one a big red arrow. Don't like it at all heading into earnings. Friday's reports, Coca-Cola. There's a little bit of movement to the downside here in Coke, but I think the 53 area is going to hold. If not there, I think 51, where we've got some gap support from the prior earnings, I think that holds. I'm looking overall, and I don't really see a lot of selling. I don't see distribution coming in here on Coke. Up until here in October, I would have said that their relative strength was very strong. And even in October, volume's just been average to the downside on the selling. I'm still sticking with the green arrow. I think the overall group still looks pretty good. Just beginning of September set a 52-week relative high, or at least matched it. So I think this is a stock that's going to report strong numbers. And I think it's going to go back up and challenge that 55.5 arrow. So I'm going to go with the green approval arrow. AXP, another one I would not touch heading into earnings. It has been downtrending. I think the volume has been strong to the downside, which indicates distribution. This low right here, recently we actually went down a little bit below, came back up, got the gap resistance. Looks like maybe we're rolling back over. Look at the relative strength, though, here in American Express relative to its peers. It is, in September, it set a 52-week relative low, almost matched it in October. I just can't really see any redeeming values here in holding a stock like this into its earnings. The market doesn't like what's going on with American Express, so I think I'd have to see something good come out with earnings and then see a positive reaction and then maybe look for entry somewhere down the road. I do not want to hold this one into earnings. Kansas City Southern. I wanted to mention this one because railroads, talked about truckers being really strong. Railroads have not on a daily chart. I mean, if we go and look at the railroads, you're going to see a group that has not been performing well in the short term. Double top in July, and then we went back down and took out these recent lows, and we've been moving lower and lower. Now, the good news is we pull up the weekly chart. We've seen this before. We've seen railroads go below their 50-week moving average, didn't fail below the prior low, and then came right back up. The reason that I think KSU is one to watch, look at the relative strength in KSU versus the railroads. This is one of the strongest railroads. So this is one where the railroads as a group are going to be looking for a catalyst. Kansas City Southern is going to potentially be that catalyst. You can see it's trying to get through this 134, 135 resistance area, pulling back a little bit down $1.50 today. I like the way this one has been trading. I think the transports are eventually going to break out. I think Kansas City Southern could be a catalyst in the railroad group. So this one we want to watch on Friday morning. And the last one I have, this is a smaller company, Mini. And as far as an aggressive play heading into earnings, I think this is one that looks good to me. Back in July, we saw the volume start to come in on this move. We gapped up, printed that black candle, went all the way back down, put in this double bottom, but the volume was much lighter on the move down. And when you got a double bottom and then you come back up and you take out that high in between, which we have done on increasing volume, this one looks like it's being accumulated. Now, it doesn't trade a lot of shares, so we're not talking about Wall Street accumulating millions and millions of shares. The stock doesn't trade that many shares. But I do think that this move up and closing above 37, which it couldn't do earlier in the year, that it's now closing at a 2019 high. And looking at the relative strength that had been downtrending for many months, I see the last 6-7 weeks completely different, starting to move back up rapidly. So I think this is one that could surprise with a report. My biggest question would be, is it built in? If it does come out with a good report, is it already built in? Are we going to pull back maybe to the rising 20-day moving average? Hey, that's something to look for. I mean, sometimes companies look really good. They come out with great results, and then they pull back and give you an opportunity. I can tell you right now, CarMax, which is in our model portfolio, here was the earnings report recently on CarMax. Look at the volume. Stock was at 87. It opened over 90. Came back down. It's been coming down to these recent lows. They beat top line, beat bottom line, raised guidance. Stock gaps up, but then doesn't continue. But if you wait and you get it at key support, price support, moving average, whatever, then you can maybe ride it back to the upside. So that's what I'm thinking about with something like MINI, Mini Mobile, or Mobile Mini. Let's say the stock does have a good number, opens at 38. That doesn't mean it doesn't come back down to 35 and a half, 36 and test some prior lows. That could be a better entry. But did I not mark this one? Hold on a second. Oh, maybe it's because it was, yeah, there it is. Okay, so I got the green arrow. So next week, when we come back here for the Q3 earnings webinar, we're going to be doing a couple things. Number one, we're going to be looking at all these reports that we're just speculating about right now. We're going to know a lot more about earnings season 1 week from tonight than we know right now. I think we're going to have a better than expected earnings season. I think that there's just too many folks that are very pessimistic. The trade war, yes, it's a problem in the near term. It's not a problem in the long term. We will eventually get a trade agreement. I think every time that there's something bad that happens there and the market tanks, I think Wall Street's accumulating. I think the mom and pops are selling out. They're getting scared. They're selling. Wall Street's accumulating. I think we're going to go higher. And I don't think it matters what happens with the trade agreement. I don't think it matters who gets elected president next year. I don't think it matters what the Fed does in the near term. They could maybe have impacts in the short term if they don't do it right. But longer term, I believe the market goes higher. So that is really what I wanted to go over for this pre-earnings sneak preview for quarter three. John, I don't know if you have anything you'd like to add, but I think that's it for me.
Hey, that's a great job. I've been taking notes here, getting my pocketbook ready. To make some big money.
Well, I want to say if anybody does buy ahead of earnings, you're taking some big risks.
Absolutely.
Make sure you're aware of that. I mean, these are no guarantees. And like I said, even some of these companies that report strong earnings may not gap up. They may gap down and they may still be good and look good, healthy, but you might have to wait for a support level to be reached. So when I say green arrow, I'm really meaning that I expect that the company's going to have a good report, not necessarily that they're going to have this massive jump to the upside. So,
and Tom, the one thing I find that if you're, some people like the action in front of it, like some of these stocks can move dramatically either way, long or short. But the one thing I have found personally is if I see something, generally I don't hold stocks into earnings. If I'm looking for a quick trade here or there, it'll generally be fairly minimum. So if I normally would trade 100 shares on a stock, I might do 20 or 25 because these moves on some of these, you take a look at Netflix as an example, that could be a 30 to 50 point move on that stock. Either way, right? So you have to really accept the fact that if you get involved in a trade and you're wrong, it can be extremely painful. So you have to really be careful, deploying your capital. Often what I'll do, Tom, is I'll wait till a company reports and then see how the market responds and maybe take on a position after that. But I just think you have to be careful with putting too much capital into a stock when it's 50-50 at best.
Yeah, and the difference for those of you who aren't familiar with our service, I mean, we have portfolios where we do hold stocks for 90 days, so we will hold them through one earnings report. But our trades, when we talk about our trade alerts and things like that, when we put trades out, we do not hold those into earnings. As a short-term trader, I think that is that's a no-no. I just think it's taking on too much risk. If you're going to try to trade, you really want to minimize your downside. And like John was just saying, how do you minimize your downside going into an earnings report on Netflix? I mean, I guess you could maybe play a put. You could own the stock and maybe also buy a put just in case, the stock goes down a lot. You protect yourself a little bit with the put. So there are ways maybe to protect yourself a little bit. But if you're just holding a stock and going into an earnings report, you're really taking a big risk, and especially with a stock like Netflix.
Tom, I have a question for you.
Yep.
From a participant. We're going to wrap this up. Regarding the 10-year Treasury, is the correlation for higher equity prices only true for bull markets? Great question.
Well, the 10-year Treasury yield, even during bear markets, I'm going to go back and pull this up. Let me pull that chart up. So I had this for 10 years. We could go back and take a look at it. I think that the correlation, without even going back, I think the correlation won't be as strong. And the reason being, when the yield's going up and money is coming out of treasuries during a bear market, especially a secular bear market, my guess is that a lot of that money simply moves to the sidelines as opposed to into equities. I think some of it would move into equities, but I'm going to stretch this back to 20 years, and so this will take into account, the prior bear market. And so, okay, so here's the S&P and here's the 10-year Treasury yield. So you do still have moves here, and the market does, or the S&P does go up, although here we peaked in the second quarter and we were already starting to roll over on that one. Here, when we had a big move up in the 10-year Treasury yield, we went higher, but we didn't go a lot higher. The one thing that really stands out to me, though, that's different than what we've been seeing for the last 10 years, look at when we have steep drops in the 10-year Treasury yield. This means money's going into treasuries. What is happening to the stock market? Is it consolidating like it has been for the last 10 years? I don't think so. Not during these secular bear markets. When that yield drops, the stock market's getting crushed. And so a lot of times you have positive correlation there, whereas in this current period, last 10 years, sometimes when the yield is dropping, we actually see correlation turn negative because the stock market still goes up even with this yield going down. But I think if you look back at the last two secular bear markets, when the 10-year Treasury yield is in steep decline, so is the stock market. And that's one of the big differences because there's no new money coming in. It is simply money rotating out of stocks and into treasuries. I think we're in a completely different market now. And again, I think even just the last year, look at what's happened. We had this big drop. Initially, we had a pullback. That was that 20% cyclical bear market within a secular bull market. After that, we kept going lower. But look, the stock market recovered. So again, I think we're in a different market now than we were back in 2000 to 2009.
Okay. Listen, on that note, let's wrap it up. I want to make sure everybody realizes they're going to get a copy of the recording. Hopefully tonight, latest tomorrow morning. Really appreciate you taking the time. Tom, you did a terrific job. Thank you so much. And remember to check out, if you're already a member, you're going to get invited to next week's event, which is going to be, I can't wait. There's so many stocks reporting earnings and coming up reporting earnings. It's going to be, I think, awesome. But you have to be a subscribing member. And when I send the recording out, I'll make sure I put a couple links in there for options on how you can become a member. Anyways, got a week ahead of us here. Then we'll be back here next Wednesday. Remember to check out Tom's Trading Places Monday through Thursday. And don't forget, next Friday, I'll make sure everybody gets more information about this special event coming up, and it's going to be a good one as well. Thanks, everybody, and have a great evening.